You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. And that music means we are back once again for TWIFO, This Week in Futures Options, the program here on the network where we break down everything going on in the world of futures options. Of course, my name is Mark Longo from theoptionsinsider.com, as well as from the ever compelling, at least we tend to think so, Options Insider Radio Network. If I sound a wee bit different, it's because I'm not coming to you from our studio in Chicago, but actually from on location down here at the Futures Industry Association Conference. Been here all week, kind of getting the lay of the land, catching up on all things futures and market structure and all of that fun. Also sourcing out some fun new guests for the show going down the road. So a lot to look forward to coming from this conference in the weeks and months to come here on the show. And of course, if you want more shows in your life, and who doesn't these days, these markets are crazy. We all need a little bit of hand-holding out there. Then theoptionsinsider.com/pro is the place to go to learn more. Of course, you get live access to this and everything else we do throughout the week, as well as pro Q&A sessions, options oddities at the end of the week, great giveaways like our great pro Q&A, or I should say our pro trading crate, and a whole bunch more. Theoptionsinsider.com/pro is the place to go to learn more. As we keep on rolling, see who's joining today, holding down the old CME Group hot seat, our old friend, Mr. Rich Excell, the assistant professor of finance over there at the Gies College of Business at U of I. Mr. Rich, welcome back to TWIFO, sir.
I'm glad to be here. It's been a while, but a lot has gone on since then, and I'm sure there's a lot to talk about today.
It has been. I mean, really, in some sense, it's only been since December, so it hasn't been that long. But on the other hand, this beginning of this year has been an eternity in the market, so a lot to unpack. So without further ado, let's do just that. It is time for the Movers and Shakers report.
Rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everyone, welcome to the Movers and Shakers report, the portion of the show where we break down everything lighting it up to the light side, aka the upside, and to the dark side over there at CME Group this week. If you want to see this report for yourselves, it's one of the few premium reports you can access over there. Follow CME Group on Twitter. If you give us a follow at Options on Twitter, we also tweet it out right before showtime. And you'll see that this week, coming into the start of the show, it is mostly biased towards the green. I would say roughly 60-40, maybe 70-30 green over red. So another biased week out there, even though there is more than enough dark side to put together a bottom five. So, Mr. Rich, as our guest, you get pride of place, sir. Where should we begin our journey this week? To the light side or to the dark side?
Let's go to the light side. Let's keep it positive.
Let's go positive. Why not? All right, to the light side we go, listeners. And coming in at number 5 this week, we have good old rough rice. Not a rough week, but actually a great week for rough rice. Up nearly 7%, 6.86%. It was number 3 in the other direction last week, off about 7.25%. Coming in right behind it, we go from the ags to the metals to silver. Number 4, 8.9% to the upside this week. Then for number 3, we go right back to the ags. It's lean hogs, up a whopping 13.64% this week. It was number 4 in the same direction last week, up a paltry 2.3%. Number 2, hanging out in the rates now, listeners. 3-month SOFR up nearly 20%, 19.68%. It was number 1 in the other direction last week, off 11.68%. They love their 0.68s out there in SOFR. And the number 1 light side mover, one of our 3 frequent offenders here on the show, taking the top spot this week. It is Bitcoin, up 24.35%. It was number 2 in the other direction last week, off 8.14%. All right, now to the dark side we go, listeners. Number 5, we have the good old peso USD. Don't see a lot of FX. Must be because Rich is on the show. We have FX making the movers and shakers this week. Peso USD, number 5, off 5.38%. Number 4, right behind it, we have heating oil, off 8.87%. So we go from FX off to energy. Stay in energy for the rest of our dark side, listeners. Number 3, we have RBOB, off about 9.25%. Number 2, it's Brent, off 10.54%. And the number 1 dark side mover this week, listeners, good old WTI, off 12.75%. So a lot to unpack there. First off, energy obviously dominating our dark side this week, with ags taking the bit in the teeth to the upside. B, one of our frequent offenders, nat gas, not making the list this week, which is kind of interesting. But WTI taking the throne, taking the reins. And Rich, I know you've been doing a lot of research out there in WTI as well. So I think we'll start our journey this week in energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everyone, welcome to the wonderful world of energy. You guys know where to find these reports for yourselves if you want to follow along with the show, either live or after the fact. If you want to check at 2 a.m., these reports are always running on a Saturday. You know where to go. CMEgroup.com/TWIFO, TWIFO is the place to go to generate all this data and a whole bunch more for yourself. And if you did so, you would see, go on in there first, go into that drop down 3 classes to energy, then over 1 in the product family to WTI. That's where we're beginning our voyage this week, listeners. And you would see WTI looking at a handle we haven't seen in some time, a 60 handle, 68.79 to be precise, as we kick off the show. Off nearly 8 handles this week, 7.89. That's about 10.3% on the week. So that's just an annihilation. Of course, if you go back to the end of our show last week, it's even more impressive. WTI off nearly 13%, or about 12.75%. So a lot of red on the crude oil screen. That is also translating into a heck of a lot of paper. As we're speaking right now, over 1 million contracts, 1.021 million contracts hitting the tape this week in WTI. You know, you've been listening to the show for a while. A decent week for WTI, somewhere in the 400 to 450 range. If we hit 600,000, that's a pretty active week. 1 million, we got to go back a ways to find that. I'll have to go dig into the dark days of everything going negative a few years back to see how much paper we put up that week. But it's been a while since we've seen 1 million contracts going up in WTI. All that a long way around to saying, Rich, it is fortuitous timing that we have you on the show this week, because a little birdie told me you've been doing some digging into all things WTI options. What's been catching your eye out there in the world of WTI these days, sir?
Well, yeah, I was doing some digging because, this month we've kind of hit the 40th anniversary of the WTI contract. And so I wanted to take a look at what's been going on for the last 40 years, but more importantly, what's going on right now in the energy market. And as you've been saying, it's a incredibly interesting part of the market right now. And interestingly, when I was writing this report, this was a few weeks ago, or a couple weeks ago, I should say, we were in that mid-70s, as you said. Now we're kind of off, into another handle. But that price is really just about the average price we've seen in the last 20 years. But we've obviously had a lot of volatility. And in looking at this, what's been driving the price of energy for the better part of the last 9 months even has been this huge release from the Strategic Petroleum Reserve. In the last half of 2022, potentially into the election, we saw the administration release about 180 million barrels and really dampen or really increase the amount of supply relative to demand. And now, if we look at it, that we're looking to release even more from the SPR to take the current level of the SPR down to a 40-year low, which is the last time we saw these levels was the last time the WTI contract came in. It's that 40th anniversary. Of course, OPEC Plus is trying to offset some of this and potentially improve that supply demand dynamic, because in my work, when I've looked at the differences of supply and demand, whenever it gets beyond 2% on a daily basis, on a rolling daily basis, that's usually when we see these bigger price moves. And we had fallen below where the supply is outstripping the demand, and that's what's leading to these lower prices. And so would we get a chance to what would be the drivers to change that dynamic? Would it be OPEC Plus changing their supply forecast, or what a lot of people were thinking, and I think what a lot of people got caught maybe the wrong way around here, is the expectation of increased demand coming from the China reopening. We'd heard about the China reopening trade from a lot of different people. And when I was looking at it myself, we could see some of that in the increases of the Purchasing Managers Index or the PMI, but some other measures of China, China economic activity that I like to look at, such as like the Li Keqiang Index or the Chinese Credit Impulse Index, were giving me a much more mixed picture along those lines. And then ultimately, when I looking at this, I thought technically we're kind of at a point where we've been, the volatility had been coming down and we were in a bit of a consolidating range. And so when I was kind of putting together the last Excell with options that focused on WTI, I said, we've got this potential supply demand imbalance. Some people are positioning for an increase in demand to take us out of there, which would look for an upside move. Others might be thinking that, we might be going into a recession and see a downside move. And the volatility markets were suggesting that, you could actually find energy. If I look at the CME Group CVOL tool, the energy volatilities were near their 12-month lows. And so the idea that I suggested was it was time to just get long some gamma. And I looked at buying an April strangle to, not necessarily saying I had a strong directional view, but it seemed to me there were a lot of forces conspiring that we were going to get a break in one direction, whether the upside or downside. It's happened that it's come out to the downside here. And so it felt to me like, we were kind of setting ourselves up for a big move one way or the other. And it looks like it's happening to the downside now. Interesting.
WTI strangles. Yeah, can't fault that one. I think when you put it on, you were probably thinking, probably the upside might be the potential home run, given what we've seen over the course of the past year. But a 60 handle was in our future, Rich, and that downside looking pretty good. And it's interesting you mentioned about, of course, the Chinese reopening. There has been a lot of talk down here at the conference about that as well. That was the anticipated trade, right? That was the thing everyone thought was going to drive demand. That was going to keep WTI at these near stratospheric levels. It sounds like, Rich, you think that's a little bit overdone.
Well, it just feels like, at this point, I guess I could see where people were coming from with some of the reopening stats we were seeing, but it feels like too many people were leaning on the same side of the boat. And that's why we're getting not just the direction of the moves, but maybe the magnitude of the moves. And as you mentioned at the start of this, the magnitude of number of contracts going through as well, right? That usually suggests to me that people are a little bit wrong-footed in their positioning and have to kind of respond accordingly. So, yeah, I wouldn't say that I necessarily, was, again, if I were predicting a directional move, I would have just bought puts, but I wasn't so confident on the direction. I was just confident that we might, if we were to get a move, we might get a big move either way.
And really quickly for our listeners, they like the nitty gritty. So what were the specifics on your strangle? How far out were you going? What were the strikes? All that fun.
I went out to April and I bought the 76, 79 strangle out in April. I think the future at that time was somewhere around 77. And so the downside break even was about 72 and the upside break even was 84. And of course, as you know, when we buy strangles, we can look at those break-even levels, but the instant gratification of getting long gamma and getting the move more quickly is always more rewarding.
Well, I like that. Obviously, in hindsight, I like it even more, but I like it. That's very tight, too. You usually see a little bit wider strangles in WTI, but 76, 79, obviously hanging out below a 70 handle right now. Vol popping. Everything's moving in your favor, Rich. What are you doing talking to me? Go cash this thing out. Go buy an island.
Absolutely.
Let's talk about some of that paper out there, see what's lighting it up out there this week, listeners. Again, cmegroup.com/TWIFO. Go in that drop down to energy and then pop it over to WTI. You'd see, like we said, well over 1 million contracts on the tape. Of that, trading a lot like an equity this week, where about exactly 25% of the paper is going up in the old April contract that is going away, not that in a few hours, listeners. So a lot of paper going out in a very short period of time here. Let's see, what is the vol right now as we're hanging out right around 68 3/4 in WTI, about a 42.5. That's up almost 5 handles, about 4 3/4 points from where it was this time last week. So not the highest level of vol we've seen for WTI, but also you could compare it to, let's say, your equity vol, which is hanging out in the mid-20s range right now, topped out around 30 recently. So still obviously substantially higher than that. In terms of skew, what are we looking at here? Obviously a little bit of action out there over the course of the past week. Given such a big move in the underlying, I would be surprised if we didn't see that. The puts last week, 3.1% cheap. This week, nearly 7% bid. So a marked premium kicking in to the put wing this week, which again is what you would expect given this relatively sharp, somewhat unexpected move to the downside. If you're sliding slowly down the skew curve, then you might expect to see the puts come in. But when you have these sharp moves in one direction or the other that surprise a lot of people, then you tend to see a little bit of a bid working into the skew, and that's exactly what we're seeing this week. Calls, a different story. Last week, they were 3.2% cheap. This week, 3.2% bid. This week, coming in 6.9% cheap. So you almost have an even 7% premium to the puts and an even 7% discount to the calls out there this week. So shaping up like a little bit of a mini equity skew out here, which is fascinating. And in terms of action, it was the 70 puts going out in a few minutes, listeners, that were dominating the tape this week with 27,000 contracts going up out here. Pretty much active throughout the week as well. The big day was Monday, though, with about 10,700 contracts. Actually, a lot of closing. So as we approached and started threatening to break through that 70 handle, it's like a lot of people were taking off some of their puts. They were getting the pop that they had paid for. They were getting the move that they paid for. They got the heck out of Dodge, or they had sold that strike thinking it was safe and they got the heck out of Dodge. Either way, a lot of closing paper going up on Monday. Tuesday, about 8,000 contracts going up, slightly biased towards opening. Wednesday, about 5,600 contracts. Today, about 2,600. So it looks like kind of closing more towards the end of the week, which again, we break through that strike. People are going to probably take those puts off. That makes a heck of a lot of sense. All right, behind it, we have the 65 puts. So 70 handle not doing it for you. 65 puts doing 22,000 contracts this week. Strangely enough, the big day for those was not Monday, but Wednesday. 11,300 going up on Wednesday. Looks like bias towards closing there. 5,500 on Tuesday, 3,000 on Monday, 2,200 today. Scattered opening and closing throughout the rest of the week. Let me go out to May and to actually the 80 calls. So it wasn't all puts all the time this week, listeners. Actually were some 80 calls lighting it up out there this week. What is the vol in May? You might be wondering. It's about a 48, so a little bit higher, up about 11.5 points this week. The puts out here this week in May, 7.5% bid were the puts and 7.9% cheap were the calls. So similar moves to what we were seeing in the April contract, just a little bit more extreme as you would expect. And of those calls, the 80 calls doing 11,355 contracts today. So a big day for the 80 calls today. I didn't necessarily expect that, but that's why you look at the numbers, right, listeners? Number 2, we have Wednesday, 9,500 contracts, 2,500 on Tuesday, 2,000 only on Monday. So not a lot of love for calls earlier in the week. It makes some sense. Today's resurgence of the 80s, that's a little bit surprising. It looks like opening throughout the week as well. So people were piling into 80 calls out here in May throughout the week. Again, a little bit surprising. Right behind it, we also have the May 65 puts doing 17, nearly 18,000 contracts. The big day for those, Tuesday, 6,000 contracts there, 5,800 on Wednesday, 4,000 today, and about 1,800 on Monday. Again, back and forth, opening to closing throughout the week. Let's look really quickly and scroll around, see if we can see any other interesting and or aberrant prints. How about the 50 puts, listeners? 50 puts in June. I didn't think we'd be talking about a 50 handle this week, but that's what we've got going up out here in June. 17,500 of the 50 puts going up this week. Let's dig in to see how they went up. Looks like they went up mostly yesterday and today. 8,200 yesterday, 7,200 today, 1,400 on Monday, and only a few hundred. 1,400 on Tuesday, only a few hundred on Monday. Mostly opening throughout the latter portion of the week. So some folks looks like opening for size out here on the 50 strike in June. Intriguing. And that's not enough, listeners. We go a little bit farther out. It's not all downside. It's a lot of downside. We have the July 50 puts also trading about 50,000 times this week. And then, not to be outdone, the DEES 85 calls also going up 21,566 times this week. Pretty much all of that yesterday and today. 10,600 yesterday, all that opening. 10,800 today, also predominantly opening out there. So again, total about 21,500 on the day against OI of just 16,000. So a lot of paper piling into the 85 calls in December. So Rich, it's a lot of the paper I expected. The 70 puts, I expected those to be lighting it up. 65 puts, also not surprising. 50 puts, maybe those are a bit of a surprise. I didn't expect to see a lot of paper going up out there. And the 85s, certainly a bit of a surprise to me. And you know what, Rich? I buried the lead here as well, because also if you go all the way out to December of 2024, we have even more call paper. In particular, it looks like the 135s. Actually, it looks like it's the 110, 135 call vertical going up 7,000 times yesterday and 7,000 times again today. So all sorts of funky paper going up. Any of that catch your eye or resonate with you this week, Rich?
Yeah, there seems like a lot of different moving parts going on there. I look at those calls that are trading earlier, like I think you mentioned some June calls, et cetera. To me, I wonder if, especially when skew is getting so steep with the premium to the puts, if that's really just not somebody who's getting short futures and using that call as a stop on their position. Instead of buying puts, they're trying to create that put synthetically, perhaps. So I think to me that's kind of consistent type of positioning. If you look out to that December 2024, yeah, I mean, to me, like we talked about, or I talked about in my report, the SPR being at a 40-year low, I think there's still a lot of people that think that is not sustainable, and that's going to have to refill that at some point. There's probably some near-term recession fears, especially given what we've seen with some of the banking problems. And so I think that's probably impacting some of the near-term views. But as we look further out on the other side of that, I think there's that supply demand I talk about might be shifting a little bit in some people's minds as we go further out.
Well, speaking of shifting, this is normally where we would shift to nat gas, which is usually dominating our tape in the energy space. But as I mentioned, not in our movers and shakers report this week, listeners, and only about 347,000 contracts on the tape. So not even a very active week for nat gas out there, as it's hanging out right around the 2.5 level right now. So instead, we'll transition into another complex that was dominating our movers and shakers this week. It is time to talk about ags.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, everybody, welcome to the wonderful world of ags. Same deal. Go into that drop down, cmegroup.com/TWIFO. Go all the way up to the top of the list where you will find ags, and then pop over two in the product family to corn. And you will find, or actually pop them in one to the grains and oilseeds, and you will find corn right there at the top of the list. A lot to unpack. But Rich, we mentioned ags were kind of dominating our light side this week with lean hogs and rough rice all making it in there. If you expand it to a top 12, we also have corn there up nearly 3% this week. I highlight corn because I know when you're not busy profiting immensely off WTI strangles, you've been trading and tracking a little bit of corn as well. What's been catching your eye out there in corn this week, sir? Yeah,
for sure. So yeah, I'm focused on corn a little bit because we're getting the USDA prospective plantings report here at the end of the month in a couple of weeks. And so I wanted to be thinking about what can happen here going forward. I talked about a lot about how food prices and inflation have been on top of mind for just about everyone, not just traders, but consumers, policymakers, et cetera. And we have been seeing a pullback in food price. So you look at the UN food price index, just look at any sort of any of the futures. I kind of focus on the ag futures like corn, soybeans, and wheat, but they've all been pulling back quite substantially in the last 9 months or so, and then that's been pulling down the goods portion of the the CPI, right? And so what does that mean for for Fed policy and things of that nature? Kind of pulling that again, and what else do you think about when you think about the ags? You think about prospective plantings. You have to think about weather. I just told you got back from vacation. I was on the West Coast. Whether you're in the mountains and skiing and you see, a base of 50 feet of snow on the base, or if you're out in the Bay Area and seeing the atmospheric river weather patterns, that there's been a lot of precipitation in the United States this year. In so much so that, it's even starting to relieve a lot of the drought conditions that we've been seeing out in California, but also across the country. And so, that's a bit of a change that we've seen from years gone by. And so how is that potentially going to impact what the farmers are thinking as they're kind of going into the planting season here? And then, coupled with, we also think about that weather, you have to think about temperature, right? And the warmer than average climbs we've been kind of seeing, very mild winter that we've had here in the Midwest and going down into the Southeast. And so, there's a lot of uncertainty that's unpacked in all of that stuff, right? We're looking at how is maybe Fed policy because of inflation and with all this weather. And so, not surprisingly, you'll hear me say I would looking to get long some convexity, like get long some gamma and some vega in the ag space as well. Because whenever there's uncertainty, we talked about in the energy one before, talk about it here in corn. When there's uncertainty, if the price is right, I'm always looking to add that kind of long gamma, that convexity to the portfolio, because you can skew it a little bit directionally, but I think having that kind of long options profile can help you. If we look empirically at what corn futures and especially have done the last 2 years around this prospective planting reports, we've always seen a very nice spike on the March 31st date that's continued through the summer. And so I was looking at, maybe a potential continuation of that sort of spike. I also looked at the May-December corn future spread and saw that this spread tended to widen out also with the March 31st date as a catalyst. Technically plotting that spread, it looked like we were kind of pulled back to a bit of a support level, and maybe that was a level from which we could expand. And so could we see potentially all futures prices moving higher? Could we see the May-December spread widen out with this prospective plantings as a catalyst? It would be, like I said, it would be tough for people to position too strongly one way, even though they might have, want to expect these types of moves because of that uncertainty. So what did I basically said, okay, let's look at what's being priced in the options market, and said, there's reason to believe volatility might pick up around that March 31st date. There's reason to believe we might see a rally in the futures. We might see a widening of the spreads. And the new crop options have been a little bit less expensive than the standard weekly corn options. And so how did I capitalize on that? I actually sold some puts. I sold some new crop weekly puts that expire on the day of the crop report. And I used the proceeds to buy some December 590 calls as well. And so it was a bit of a Texas hedge, if you will, in that I was selling puts to buy calls. But I was, again, relying on this view that I wanted to be long volatility further out, but I also wanted to, to take advantage of a widening of the spread. And so it's it's not a structure that is for the faint of heart. It's not for everybody. But if you kind of agree that there potentially is the opportunity for both all the futures to rise, but the spread to widen, it's a way to take advantage of what the volatility market's giving you to get a long delta spread on. It gives you a little bit more attractive break evens, gives you some leverage to an upside move.
I like it. A bit of a time bullish risk reversal there. Kind of intriguing. You always have interesting structures to your trades, Rich. I like it.
I'm just trying to take advantage of what the market gives me.
Exactly. And that's one of the interesting things about futures options, listeners. That it's not just all about verticals and all the things we see all the time, but actually the term structure. Very important, especially when you're talking about ags. Ags have that old crop, new crop rotation. So there is always interest in the term structure out there. And we see the liquidity lining up that way as well. Now, speaking of liquidity, let's see what we see out here in corn this week. And all things considered, listeners, it's a decently active week, about 360,000 contracts on the tape. It's no WTI, but then again, what is outside of WTI today, listeners? And in terms of action, about almost 31% of that coming in the May contract. That has about 36 days to go. So we're going to hang out there That's a typical liquidity pattern that we see for corn options out here. By the way, listeners, where is corn hanging out right now? 632, up 14, almost 15 handles. That's about 2.4%. Obviously, if you go back to the end of our show last week, you have corn up about 3%. So a decent move, most of that obviously coming this week. And in terms of action, before we even get to that, let's get out to the volatility. What is the vol in corn? You might be asking. It's about a 21.5 in that May contract, so up about a quarter. Not a huge week from a vol perspective out here, and not that dissimilar to what you're seeing out there in some of the equity products, which is why a lot of people, when they're recommending new starter products for folks who want to dip their toes into the ags, they usually recommend corn because vol levels and in terms of liquidity, it's not that dissimilar from some of the products you may be familiar with out there in the equity space until we get to the skew. That's where things get a little bit interesting, listeners. Let's look at the skew right now out here in May. And usually equity, you're used to a put being bid, a call being offered. Seeing a little bit of a reverse of that out here in corn. At least last week that was the case. It seems like a lot of that has come off this week. Last week the puts were about 1.7% cheap. The calls about 7% bid. This week the skew has moved to effectively flat, about almost a point bid to the puts and almost a point bid to the calls. So no real bias in one direction or the other. And in terms of action, what was dominating the tape out here in this about 360,000 contract week? It was the 650 calls in May, listeners, doing about 12,000 contracts this week. So not a ton, but then again, that shows you how evenly spread the corn paper is out there. And in terms of these calls, what was the leading most active day? It was Monday, about 5,600 going up on Monday, most of that closing. So folks bailing on the 6.5 calls this week, followed by about 2,700 on Wednesday, 2,000 on Tuesday, 1,800 today. It looks like the rest of the week mostly biased towards opening. Then we jump around a little bit. We go to the April contract that has about 8 days to go. We see these 630 calls. Remember, we're hanging out at a 632 right now, listeners. So these 630 calls, the at-the-money calls, doing about 10,000 contracts this week. Let's see. The big day for those 630 calls, listeners, coming on Wednesday, 4,200 on Wednesday, 2,700 today, about 2,000 on Monday, and 1,100 on Tuesday. Again, kind of back and forth, opening to closing throughout the week, which is not entirely surprising given the fact that it is the at-the-money strike out there. Right behind it, we have the 6.5 calls doing about 8,300 contracts. The big day for those, also Tuesday, 2,700 on Tuesday, 1,800 on Wednesday, 2,000 today, and 1,700 on Monday. And once again, kind of evenly mixed opening to closing throughout the week. Let's scroll a little bit farther down, listeners, to see what else we can find out here in terms of interesting and or aberrant paper. Let's go out to July. The July contract, which is trading a little bit lower at about a 615 right now, and the vol out there about a 23. So similar from a vol perspective. A huge bid to the calls last week, 17.6% bid last week. This week, about 5%. So all those big bids we saw in the calls last week, all of that going away this week. But we did see these 600 puts leading the dance out there this week to the tune of 7,000, pretty much exactly. 3,200 on Tuesday, 2,000 on Wednesday, and about 1,000 each today and Monday. It looks like opening throughout the week, so a lot of new positioning going up here on the 600 puts in July. Let's scroll a little bit farther down. Let's see if we can find anything else dominating the tape. And you know what? You go a little bit farther out. We go all the way out to December of this year, where the future is trading 558. So again, much lower on the futures front. The vol about a 23, so similar level to what we were just talking about for July. And it was the 700 calls leading the dance out there in December this week, doing about 5,500 contracts. The big day actually today. Looks like it might have been a 650, 700 call vertical going up today, or potentially even a bit of a roll. It's like the 580, 610 vertical also traded 2,500 times. So maybe rolling from the 580, 610 to the 650, 700, or perhaps another four-legged spread going up out there. Either way, a lot of paper going up out there today in these contracts out here in corn. Rich, any of that surprising you out there? Any of that maybe inspire you to leg into some more funky time spreads in corn, sir?
Yeah, I mean, it doesn't surprise me. You can start to see. I mean, we still have a couple weeks left to this catalyst, but I think people are expressing their views, where at the point of the curve where they think you're going to get the biggest pop. And I think it's interesting that, like you said, some are going to focus on kind of going out towards that end of the year, and there's that volume out there. I think, you have to, others like myself that were kind of thinking of that, yes, you might see a move higher in that kind of December future area, but you might see a little bit more of a widening of the spread of the May, December, or maybe, July, December, et cetera, and playing for that. So that's the beauty of futures options. There's just so many different ways you can kind of torque that position to give you the most bang for your buck.
In terms of bang for your buck, a lot of you folks are looking that way for the equities. So I think off to the equities, we're going to go next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everyone, welcome to the wonderful world of equities. Very topsy-turvy this week. Of course, no sooner do I leave town for a conference than the whole market falls apart, but we're seeing a little bit of a rally out there today, a little bit of a resurgence, perhaps some of the ongoing fears of contagion in the bank sector, perhaps being put to rest a little bit. A lot of that being reflected in the equities and also in the vol space. Even though vol is coming in today, it is still net up on the week after the pronounced bid we saw towards the latter portion of last week, the beginning of this week. A lot of that still felt in there. So VIX, as we kicked off the show, was at about 2370, puts it up about 3.35 points from where it was this time last week. So again, it was right after our show last week where we started to see vol kick into another gear, and we're still seeing the remnants of that out there today. Also, VVIX itself. Remember I said, listeners, when it hit about 75, it might be a level where you might want to start paying attention. Chances are it's not going to hang out there for too long, and that is the case at about a 110, almost a 111 right now, up about 28, almost 29 points from this time last week. That's a huge vol move. I'll have to go back into the archives to check for sure, but I'm hard pressed to think of the last time we saw vol move that much in the span of a week. Vol Q, 24 and about a half. That's actually down a little bit, down about a third of a point. Of course, we have seen NASDAQ moving all over the place over the course of the past week and leading the charge out there again today to the upside, up well over 2% at one point today. That puts that VIX to vol Q spread, so that S&P 500 to NASDAQ vol spread close to a point, about 0.9. That puts it a whopping 3.65 points higher. It's going to be tighter than it was this time last week. And again, that's been kind of an interesting phenomenon we noticed starting the beginning of last week. VIX and vol Q, so NASDAQ and S&P 500 vol, trading almost exactly the same level, quite a bit last week into this week. So not a thing we see very often, and also a time when probably you want to sit up and pay attention, because those relationships tend not to last for too long. But Rich, we can probably do several hours on what's going up out there in the equity market right now, but obviously a lot going on. A lot, I'm sure, is lighting up your tape. What is catching your eye in the world of equities these days?
Well, to me, what's catching my, most people would say that the banking sector, as well, it should be, right? But to me, it's the response to the troubles we're seeing in the bank land and how the equity market is responding. As you mentioned, what we're seeing in the NASDAQ 100 and what we're seeing in a lot of what I would call longer duration assets that have a lot of their value impacted and far out in the future, not in the near term in terms of cash flow. That usually is tech and biotech type of stocks. They're responding very favorably, expecting the Fed to be, if we look at the terminal Fed funds rate, it's come down from 5.7 to 3.7 in expectations for this year. So that reduction in interest rate expectations is right now seen as in a positive light in the riskier parts of the equity space, which I think is somewhat interesting, even though we might be looking at pricing a recession, as we were talking about with the energy futures before.
Let's see what kind of recession they're pricing in out there in the E-mini right now. Listeners, again, go into that drop down and then pop out of ags and scroll down 3 more spots to equity indexes, go into U.S. index E-mini, and then to the E-mini S&P 500. And certainly from a volume perspective, they are responding to all these whipsaws we're seeing throughout the week. Already almost 5.2 million contracts on the tape this week, listeners, for the E-mini. So usually this time of the week, we might be at 2.5, 3 million. All over 5 already. That's a pretty aggressive week. And because it is an equity, most of that's going out tomorrow. About 20% of that paper going up on the 17th, which is, of course, our traditional monthly expiration. So pretty much tomorrow. And we're looking at right now, what is the vol out here in the E-mini? I said we were flirting with flirting with a 30 not too long ago. A lot of that vol coming in. It's at about a 20 right now. Again, it's a 1 day to go contract, so take vol with a little bit of a grain of salt, but still intriguing stuff nonetheless. Speaking of intriguing, we've talked for a while about how many nonsense puts are going up out here, and that is still the case. We have the 3,300 puts went up 45,000 times this week. Those are expiring in a couple of minutes. We have the 3,330 puts. If 3,300 was too far off for you, how about the 3,330s, listeners, going up 30,000 times this week? Those expire in 4 days. But let's ignore that nonsense. Let's go a little bit closer to the fire. In this case, we're going to the 3,800 puts expiring tomorrow, going up 50,000 times this week. Yes, 58,000 times on the 3,800 strike. Again, I said coming into the start of this segment, we're at close to 39.5, almost exactly 39.49. It seems like just a few minutes ago, because it was, listeners, we were hanging out in the 3,800 level, 38.5, floating and flirting around with that 3,800 level. So just, I could see why a lot of people were trading these 3,800 puts fast and furious this week. Pretty active almost every day this week. 17,000 on Wednesday, and then almost 17,000 again on Monday. So equal paper both days. About 14,500 on Tuesday and about 10,000 today. It seems like they were net biased mostly towards closing throughout the week. So we never broke the 3,800 level. So apparently folks never really had a chance to maybe profit the way they hoped. But nonetheless, a lot of closing paper out here on that 3,800 strike. Right behind it, we have the 3,700s going up 43,000 times. So again, just a tsunami of paper on this near-dated stuff, listeners. The big day for those, 18,000 on Monday, actually opening then. So we were closing on Monday on the 3,800s and then opening a similar amount of paper on the 3,700s on Monday. So perhaps some folks were rolling 3,800, 37. That seems like a pretty dire roll. But then again, we were hanging out 38.5, a little bit below it in that time. So it doesn't seem as outlandish as it does now. Either way, a lot of paper opening on the 3,700 puts on Monday. Hopefully you're selling the hell out of those, listeners, because not looking that great right now. 12,000 on Tuesday, also opening 8,700 on Wednesday, and about 5,000 so far today. That said, it hasn't been all puts all the time, just mostly puts. There were calls going up this week as well. 3,900s now in the money calls, about $50 in the money calls, going up about 35,000 times this week. The big day, not surprisingly, today, 12,000 today, 10,500 on Wednesday, 9,000 on Tuesday, 4,000 on Monday. And again, opening throughout the week on that 3,900 strike. So folks are pretty excited about 3,900. And not to be outdone, the at-the-money strike now, 39.5s, also doing 35,000 contracts this week. Strangely enough, the big day for those was actually Tuesday, about 16,000 on Tuesday, most of that opening, followed by about 10,000 and change today, and then 5,000 on Wednesday, 3,700 on Monday. A little bit of back and forth Wednesday and Monday in terms of opening, but still a lot of paper flying fast and furious these days. And you're looking at the equities, you don't really have to go much farther than a few days, listeners, to see the lion's share of the action. Looks like if you go out 8 days, contract expiring on the 24th, we had 25,000 of the 3,700 puts going out there as well. So 3,700 puts were active. In fact, if you go a little bit farther out, 15 days, listeners, that's an eternity in the E-mini right now. So the end of month, March, 3,700 puts expiring on the 31st. They also did 47, almost 48,000 contracts this week. So that 3,700 strike was clearly a popular one throughout most of the week, including yesterday. 25,000 going up yesterday, 10,000 on Monday, about 8,000 today, 4,000 on Tuesday. Looks like the lion's share of that paper yesterday was closing. So again, we didn't quite get to that 37, didn't even break 3,800 really. So 3,700, perhaps a bit of a bridge too far, folks deciding get the heck out of Dodge yesterday, even though they do have time. Like I said, that is a 15-day contract. So for equities, it might as well be 5 years. So intriguing stuff out there. Now, Rich, you and I haven't chatted since December. And even then, the 0-day phenomenon was going on. It was popular, but it really has kicked into a almost ridiculous gear over the past few months. So let's start there. What are your thoughts on this just explosion of same day and 1 day paper we're seeing in the equities right now?
Yeah, I don't think it's sustainable personally. I mean, I come from the world of FX, as you know, and, this goes back to the 90s, we would have, twice daily expirations. And, if we look at it on a global basis, we'd have, Tokyo expirations and we'd have New York expirations. And so, kind of familiar with trading and using 0 day options. To me, it's just been kind of a phenomena that's taken off because of so much uncertainty that different traders are having. And you have people who feel very strongly on both the bullish and the bearish side, and they were responding to different data points on any given day. And so this was perhaps seen to be a little bit more of an effective way, to just kind of day trade, if you will, using just a little bit of premium. My sense is that this too will pass, and I don't potentially see the same. The options aren't going away. I should be careful to say, but I just think the interest in them will start to wane as people start to as their profitability starts to wane, shall we say?
So we're not going to see an Excell with options trade in the 0 day anytime soon?
You're probably not. No.
All right. Instead, let's keep on rolling. See what you folks have on the brain, listeners. A little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Welcome to your feedback segment. You know how to reach out to us at Options on most of your major social media platforms. Questions at theoptionsinsider.com also works. If you're a pro member listening live, you can also submit your questions in the live chat or via our members hotline. Those always manage to percolate their way to the top. Before we get into some of the questions, let me quickly pay off some of our questions of the week we've had, because it's very much touching on the topic we were just talking about, all things 0 day. We asked you last week, listeners, there have been a lot of questions about 0 day options lately. One of the most common we see from you folks is, when will we see 0 day contracts listed beyond the index? So in some of the single name equities you like to trade, like your Apples and your Teslas and all the other big contracts out there. So we put that question to you last week. Will we see it this year? Yes or no? And our audience, a surprisingly optimistic bunch, ever so slightly, 51.1% saying yes, 48.9% saying no. I probably would have to lean myself on the no side of that, listeners. I talked about it before. And again, doing my rounds at this industry conference this week, it doesn't seem like there is an enormous impetus for that. That said, we saw names like Bank of America put up over 1 million contracts last Friday. The significant percentage of those expiring the same day. So it can be done when push comes to shove, but it doesn't seem like behind the scenes on the clearing and on the other side out there that there is a huge desire for it on the industry side. Now, the end users clearly want it, so that may materialize into these things coming along sooner than later, but I would be surprised if we do see them this year. Along those same lines, our question of the week this week, Rick was just talking about the banks and the contagion risk. That is our question of the week this week. Everyone has contagion risk on the brain this week after the meltdown, some of those recent names. So we thought we'd put this question out there to you folks this week. You are the ultimate arbiter of all things at the end of the day, listeners, our audience. And quite simply, is this a canary in the coal mine of worse systemic problems ahead, or just a tempest in the teapot? Rick, we'll put it out to you first. Which way are you leaning, and then which way do you think our audience is leaning, sir?
My sense is people are going to lean that this is a canary in the coal mine, and I think I probably would agree with them. And when I say that, I don't mean to suggest that I think this is going to be anything sort of systemic or look anything like 2008. I've kind of compared it to the Silicon Valley to more like Continental Bank in 1984 or maybe the LTCM crisis. I'm not worried about a systemic banking crisis, but I do think that what we've seen is going to cause a more meaningful economic slowdown. So I think it's a canary in that coal mine, not in the banking coal mine, if that makes sense.
Yeah, it's interesting. Our audience apparently is very split on this one too, Rich. Same numbers almost exactly. 51% for yes, the worst is yes to come. It is a canary in the coal mine. 49% for no. I will say earlier in the week, it was 70-odd% saying this is all going to blow over. Obviously, it's shifted as we've seen more names start to come under fire this week. So right now, our audience, once again, evenly split. We have the invisible man chiming in saying the Fed needs to cut rates to reduce the unrealized losses on the bank's books. Well, I don't think we're going to be seeing that anytime soon, invisible man, if that's what you're holding out hope for. But intriguing stuff. You guys can play along. At Options on Twitter is the place to go. You have about a day left to make your voice heard out there. Speaking of making your voice heard, let's get to this one, Rick, from Patronal, P-T-R-O-N-L, writing in to say, what are the easy for me to say, what are the host's thoughts on the best ways to get long-term crude oil exposure in these markets? I'm okay owning WTI around the 70 handle. That's a good thing because that's pretty much where it's trading, a little bit north of that, or a little bit south of that, I should say, for WTI. Your level a little bit north of where it's trading right now here, Patronal. But it's an interesting question. We get this a lot, Rich, usually around times when WTI has a bit of a sell-off. And people are looking at it saying, maybe I want to put some of this in my back pocket for a rainy day. Now, obviously, you just talked about your strangle. That's a bit of a shorter duration trade, an intriguing one, but not along the lines of what he's talking about here. I'm curious for you, Rich. People must ask you this. Your students must ask you this all the time. But what's your preferred way if you wanted to get a little bit of longer-term exposure to WTI? How would you go about it?
I think if you want long-term exposure, the futures curve. If you look at the shape of the futures curve, it's in your working in your favor. It's been downward sloping for quite some time and pretty meaningfully downward sloping. So yeah, I think I would just look at pick the time horizon that you think matches up with your view, and you're probably going to find a futures price further out, to kind of reflect that. If you're okay owning around 70, I would personally take a look at the options market and say, is there some way I can maybe take advantage of some skew to use options around those longer dated futures? But I'd be using the futures curve to take advantage if you're comfortable around here, because you're going to be able to buy it in the forward or the futures market much cheaper than you can buy in the spot market.
Yeah, that's usually our advice as well. Not just because we're talking about futures options on this show right now. In general, going straight to the source is usually your best bet. People tend to want to ask about ETFs and those types of products, and we always caution those, especially for this use case, the long term, because a lot of these ETFs at the end of the day, listeners, are Franken products. They're trying to approximate a futures position. There's all sorts of inherent complexities with that, including the impact of the roll yields over time. That roll yield is going to eat away at a lot of your returns and a lot of those ETFs if you're holding them for the longer term. Whereas Rich points out, if you go out onto the actual futures options curve yourself, you don't have to buy the futures. If that intimidates you, you can go to the options. We advocate for that anyway. And then find a spot where you're intrigued, maybe pick up some upside, maybe some verticals. And there's a lot you could do out there. So I would definitely be on the same camp as Rich here. The futures and the futures options, if you're okay going that road, Patronal. All right, that is going to do it for us today on TWIFO. Before we go, Rich, I know I'm going to head off the questions now, because whenever you join us on the show, invariably the feedback is, where can I see all these reports he's talking about, all these trades? So tell them right now, Rich, where can they go to see all of your Excel with options analysis and all of your trades?
Well, you can certainly go to the CME Group website to see all of the Excel with options, posts. You can also follow me on Twitter at Excell Richard. I put all of the CME Group blogs that I write, the Excel with options, as well as the other blog that I write called Stay Vigilant. That's all up there on my Twitter as well. So you can follow me there and see everything because I'm going to post it in both places.
There you go. CMEgroup.com, a great place to go. Go check out Rich's Excel with Options blog. And then when you're done with that, check out the TWIFO report. CMEgroup.com/TWIFO is the place to go. We got to get on out of here. It is going to conclude our broadcast day for today from the FIA Expo here, the FIA Boca conference listeners, of course, back again tomorrow in studio in Chicago for Volatility Views, as well as for all you pro folks after that for Options Oddities. Then back again next week with our usual assortment of content all the way through to next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.